LIBOR plus is 4. Every 3 months you pay 1/4 of that. That means my interest burden is $10 million next quarter. But if 3 months from now LIBOR goes up to 4, now I have to pay 6, right? 6 divided by 4, now I have to pay 15. Something like 2022 happens, LIBOR goes up to 10, now I have to pay 12, which is 3. I have to pay 30 now. So I don't like that. So I tell my counterparty, how about we agree on a fixed percentage? It's called a swap rate. I pay you that. And you pay me LIBOR. So let's think about my balance sheet. My liability is LIBOR plus 2, right? Plus I commit to a swap rate, but this is liability. You pay me LIBOR. Oh, these guys cancel each other. So my at least cash flow from this, I'm gonna pay whatever that swap rate plus 2. Now it doesn't matter whether LIBOR next quarter is 1% or 21%. I'm going to pay exactly the same thing. And things like LIBOR constituted the reference rate for these. And first time something like this was done in early 1980s. World Bank had a variable rate loan that they didn't want to commit to. Interest rate uncertainty was very high in early 80s. So they found a counterparty who was willing to take the other side. That was the first swap that was ever made. But later on, banks realized we can actually run books on these and manage the mismatches ourselves. It, it became a very, in fact, it became the driver of the interest rates itself. I mean, technically speaking, uh, you could figure out what that swap rate should be using the term structure of the interest rates. But the way how deep swap market was, swap market itself started determining what the interest rate structure would be. Back early 90s, you put very experienced traders in the swap desks. Now you put starting guys into swap desks. It has become so much vanilla. And there are also, oops, many interest rate derivatives. Not just swaps. There are, for example, options on swaps that are called swaptions, okay? Or some weird stuff. Mortgage-backed securities, collateralized bond obligations. credit default swaps, etc., etc. Okay? If they ever let me teach a fixed income class, I will teach these things, but they're not very interested in it. These were my specialty when I was in the market. The trouble with this is all those 20 to 50 banks in LIBOR consortium are also major players in these markets. Sometimes they take positions, especially when it comes to stuff like options, depending upon exactly where LIBOR ends. Uh, you may have to pay a lot, you may have to pay nothing. So these people had kind of incentives to manipulate it. So LIBOR was open to manipulation, and that's what happened. People actually colluded. Let's say I'm Bank of America. I know that next month, if LIBOR is above 450, I'm going to lose $1 billion. And I go talk to uh, Bank of Tokyo Mitsubishi people, say, how about you guys do it a little bit low? Let's keep it below 450. Next time you need something, I'm going to do the same thing for you. And there were rumors of this going on all the time anyway, but there was a big investigation in late teens and early 20s. All this stuff came out. A lot of banks were fined. In fact, LIBOR does not exist anymore because of this. The nice thing about LIBOR was also the basis for a very useful uh, interest rate futures market. Interest rate futures market. This was called the euro dollar futures. The name euro dollar is kind of a old thing. Back in 70s, there was a regulation in U.S. that limited how much banks could pay their time deposits as an interest. It said 3%. Of course, mid to late 70s, inflation was high. People wanted to get higher than 3%. So how do you do? As usual, necessity is the mother of invention. U.S. banks started deposits where you still deposit your money as U.S. dollar, but the institution that borrows the money from you is outside of the U.S. banking system. At that point, it was in Europe, so those were called euro dollars. Later on, that regulation went up, but the name kind of stuck. A euro dollar is US dollar denominated deposit that is domiciled outside of US. That's all there is to it. Euro dollar futures are bets on what the what LIBOR is going to be sometime in the future. For example, let's say maturity is 3 months. Future rate is an interest rate for a 3-month loan that starts in 3 months. This is called a forward rate agreement, or sometimes just FRA. So regular 3 month rates. I borrow $1 million now. You charge me for 3 months. I pay you 3 months from now. The forward rate agreement. I don't need the money now. You're gonna give me the money in 3 months. I will pay you back in 6 months, but we agree what the rate is gonna be today. You don't have to wait for 3 months to figure out what that rate is. In fact, it is these FRAs that pretty much drive those swap rates. And of course, you could do this for a loan that starts in 3 months, 6 months, 9 months. In fact, you could have done it up to about 10 years. These are important if I'm going to be managing my risk, right? Suppose I'm a swap bank. I run a swap book. Some of my clients are going to be floating payers. Some of my clients are going to be floating receivers, but I'm kind of the intermediary between them. So there will always be some imbalance. Sometimes net I'll be a floating payer. Sometimes net I'll be a floating receiver.